Hindsight's a terrific thing. I would have backed the winner of last year's Melbourne Cup if only I'd known which horse was going to be first past the post. In fact, I'd have gone for the whole trifecta. Now, it's traditional at this time of year to trawl through the ashes of the past year and marvel at just how obvious it all was, and then makes a whole series of wild predictions that have a less than 50% chance of coming true. Now, last year it was all about yield, or at least the second half of the year was. As interest rates headed lower, all those investors sitting in high cash, high yielding deposit accounts suddenly were forced to look elsewhere. And with some companies, like the banks and Telstra, paying dividends north of 10% on the purchase price of the shares, that was where the cash headed. And it just kept on heading there. Not just from local investors either. Foreign investors also piled in as well, and that helped push the Aussie dollar even higher. It also helped fuel a 13% lift in the stock market throughout 2012. Now, given the banks rose about 20%, you can see where the push really came from. But there comes a point after the share price has risen so far that either the yield starts to shrink or the companies paying the dividends can't afford to keep pushing dividends higher just to attract investors. And so investors have begun to broaden the search in the hunt for yield. And some of the ugly ducklings of the past 4 years suddenly have found themselves back in favour. Take the listed property trusts. They were the group among the hardest hit by the financial crisis, and once again they're in hot demand. They've been unloved since the financial crisis, but they've spent the past 4 years trying to rebuild their businesses and their reputations, reducing debt, slimming down their structures. Now, as a result, they now deliver decent yields, and with earnings growing, they have got some spare gas in the tank to keep lifting dividends. And that's a really important point. Don't just look at the dividend a company is paying now and dive in. Dividends aren't ever rock solid. If earnings drop, the dividend is likely to be slashed. So do some homework, ask yourself whether there's any growth potential in the company and its earnings before you buy the shares.